Hello and welcome to the Unleash Your Retirement podcast with your host, David Corin. I'm Wendy McConnell. Hi, David. How are you?
Outstanding. A little cold, but outstanding. Yes.
It is a bit nippy out.
It definitely is.
Yeah. So we have a guest today. We have Mike Smith. He's a recurring character, I like to say. He's been a guest numerous times. So welcome, Mike.
It's good to be back, Wendy. Thank you.
I always have a hard time remembering your name, Mike Smith. It's a really tough one.
Yeah, and today we're going to be talking about making your distributions in retirement. So in the last episode we talked about the phases of retirement. The go, the slow go, and the no go years. So if you're going to be in the go, if you're going to have a go time period in retirement, how much can you take up, and how do I take the money out, and where do I take the money out of first? That's always a question. Should I start taking Social Security early? Should I wait? All of these questions are questions that come up when people start thinking about retirement. Okay, well, now let's get real. Let's get into the nuts and bolts. And that's what this is really going to be talking about, is getting into the nuts and bolts of really how to plan your distributions coming out of your assets, and what's your income going to look like, and where is it going to come from? Because that's a big deal in retirement.
Absolutely. Tell me, how's it going to look?
Well, there's a lot that goes into this. First of all, people spend their whole life, hopefully, setting aside money at their work plans, getting the tax breaks. The money's growing tax-free. It's giving you a tax break, income-free. But there comes a time when you need to take the money out. When you retire, and a lot of people are reluctant to. They say, hey, I don't want to spend it. I've saved it. I don't want to touch that bucket. But a lot of times it's not only necessary, but it's the right thing to do. And hopefully you have several buckets that you could pull from, as David mentioned. Which one do I start with? And just realize, as David mentioned in his last podcast, your spending's not going to be even. You probably will spend more the first few years. With vacations, home repairs that you just haven't had time to deal with, pulling trees down, whatever it might be. There could be a few years of heavy withdrawals, and that is okay in most cases. One other thing to look at too, with your retirement plans, there will come a point where you have to take money out. It's called the required minimum distribution. Fortunately, that has been pushed back to 73. It used to be 70 and a half, and at that point, you'll need to take a percentage of the retirement account out, and that'll be taxable income that you will recognize.
Now, how much do people have to take out, Mike? That's a lot of people think it's not much, but turns out.
Yeah, it's based on a table that the IRS will put out. They'll look at your year-end balance of the retirement account, and then they have a table is based on your expected life expectancy, remaining life expectancy. So typically, I think it starts close to about 4% on an account. So you'll have to look at the entire picture, Wendy, where you have, what's my Social Security going to look like? When should I start Social Security? What will that RMD probably be? You'll want to have all this mapped out. And one other thing that I'm just going through this process myself. I'm working on RMDs for folks, but also remember, if you're fortunate enough to have an inherited IRA, you'll have to take care of that as well. And if it's coming from someone other than your spouse, you now need to take the money out within 10 years of inheriting that IRA.
All right. I had a question, but it just slipped my mind. So please pretend I'm not here.
Well, a lot of people have questions about, how to take money out of their retirement assets. And it's not just the RMD. You have to think about, okay, should I do a Roth conversion? In other words, should I convert some of my IRA money or the money I put away for my 401k at work or what have you? Do I want to convert some of that to Roth? And why should I do that? Or if I should do that? You may have investments, brokerage accounts and, taxable investments that you put money into or inherited. A lot of times we see a lot of inherited assets in that category. And should you use that money early on, or should you wait? Should you let that grow? What's the strategy around that? So these are different. I like to say people have these different buckets of money to pull out of. One is what we call taxable or brokerage account type money. It would also include cash, right? Do you use up your cash? A lot of people will build up, a lot of cash prior to retirement thinking they'll need that. The other is the Roth bucket. The Roth bucket is unique because it's tax-free money, right? You don't have to worry about taxes when you take the money out of there. The IRA, on the other hand, you touch that money and it's never been taxed, so it's income and you have to pay tax on it. And it raises your income and it raises your taxable income if you take the money out of there. That's why the RMD can be a little bit of a shock to people, especially if they've gone along, right, all those years not having to take money out. And then when they have to take the RMD out, it's a lot. And it throws them into these higher tax brackets. It creates IRMA issues for them. It creates it causes more of their Social Security to be taxed. All kinds of issues come up because they didn't plan for it. It was unexpected and they didn't realize how big their RMD was going to actually end up being. Right, Mike?
Yeah, for sure. One other thing, Dave, you just reminded me of something. You have to take these RMDs from each of your previous employer accounts. So if you have old 401ks, several of them from when you've moved and you haven't consolidated, those will all have to have separate RMDs. You'll have to track that. If you have multiple IRAs, you could combine that into one RMD, but you may want to start to consolidate some of these previous employer accounts as you get closer to retirement.
Well, it sounds to me like the more you have, the higher the required minimum distribution is going to be, correct?
That's correct.
Because it's a percentage.
Yes.
It is a percentage. That's absolutely correct. And every year it goes up.
Okay.
The percentage goes up. So, and if the account grows, but let's say you start out pulling out 4%, but your account grows by 7%, so it actually got bigger. Now the next year you have to take a higher percentage out and of a bigger number.
Right.
And people
so we don't want it to make money.
No, you do want it to make money. That's not the case. You just need to be prepared to understand what impact it's going to have from a tax perspective for you in your retirement years. So that's again, we talked earlier about having a plan. Well, part of the plan, this is the nuts and bolts, this distribution of a plan. That's really what we're talking about here. So, if you, let's say you retire at 62, right? I'm going to use 62 as an example, because what happens if you retire at 62? Well, guess what? You're not on Medicare yet. So you got to account for health insurance, which, by the way, if you go into open market to buy health insurance, it is not inexpensive. We're talking $10,000 or more a year for your health insurance. Now, you may be lucky enough to be able to have a plan through work they let you keep or something like that. But for many people, if they do retire early, prior to 65, they are faced with having to pay out of pocket for healthcare expenses. So you've got to consider that. Do you take Social Security? You're eligible at 62. Should you take it then? Well, there's a lot of calculations that go into that, right, Mike?
Yeah, absolutely. One thing to remember is if you take that at 62 and you were the higher earner and you were to die, your spouse would inherit that your benefit, and it's going to be pretty low at 62. You're going to take a 30% discount versus if you waited to your full retirement age. For most folks is around 67.
Yeah, so so when do you take Social Security? We would argue, so that would be an example where we would probably look around and say, do you have any non-qualified or brokerage or cash on hand? We'd want to use those assets first during those years to allow your Social Security benefit to get larger and larger and larger, because every month you wait, every month your Social Security benefit goes up. So you want to wait if you can, if you have the health and everything, especially if you're married. Because like Mike was just saying, when you pass away, if you're married, if either of you pass, one Social Security benefit is lost and one is kept. The one that is kept is the largest one. So you want to make that, whoever's got the big, you want to make it big, right? Because you know you're going to lose the smaller one. So you want to make sure you grow that as much as possible. So where do you go to get those assets? So early on, it may be we pull it out of cash and or brokerage money, but maybe you don't have a lot of brokerage money or a lot of cash. So it's okay. A lot of people hesitate. They don't want to touch that money, but it's okay to wait. It's better actually in many cases to wait to take Social Security and instead take the money from the IRA or the qualified asset, the 401k, and use that as your income flow. Because you're over 59 and a half. So there's no penalty for doing that. You just have to pay tax on it. And yeah, you don't have to take any money out of there. You're not at an RMD point at this stage, but it's to your benefit long term to wait and let Social Security grow and take the benefit out of the IRA or the 401k to cover your income needs during those years, to push it out. That's one way you can wait. A lot of people are so hesitant to do that because they've been saving all their life and they don't want to touch the money. They don't like to touch that bucket, do they, Mike?
It's psychologically very difficult, Wendy. You've been getting that check your whole life, and then it just suddenly stops. And even though you have this retirement account, it just somehow doesn't feel real to some folks. So what we've done for some people is we've tried to replicate your check. We'll say, we're going to send you a distribution from your IRA the same day you used to get paid. We'll withhold the taxes for you, and just the comfort of getting that check deposited when you would have gotten your normal paycheck, I think it helps a lot of folks.
Wow, that's nice. So is this an option as well? Is if you're a married couple, one of you could take, say, the one who will likely get a lesser payment through Social Security, they start taking that out because, again, like you mentioned, when the other one waits, and then when one passes, they get the higher of the two.
That's a great point. We do that a lot where we'll start somebody off at full retirement age. The other one will wait. And a lot of times wait all the way to age 70. So each year you wait, you're getting an 8% raise plus the inflation adjustment. So it could be significant. So at that point, you're going to have later in life 2 very nice Social Security checks along with your retirement account. And for most people, it's going to be more money than they'll need. They don't realize it. But
yeah, it's just so beneficial. And that is a strategy, by the way, that we implement for many, many clients where we just say, okay, we're going to take Sally's benefit here and we're going to wait on Joe's benefit until 70, just because that makes the most sense for your couple. And sometimes we might even have one of the spouses take it a little bit early because it's not that big of a deal impact wise. It's helpful because it reduces, let's say we have Sally take the benefit at 62, Joe waits to 70, but between 62 and 70, we've got that income stream that helps reduce how much we need to take out of the qualified account. So it's just we just do a juggling thing, say, okay, we think we can grow that money faster than what we get the growth in the Social Security benefit.
Right.
For that particular person.
Okay.
And a lot of times it is a small benefit, so we just, it works out very nicely for the client, for the couple.
We also have people who've decided to work longer in life, and they'll actually be working past the age of 70. They have their retirement work plan, and they don't need to touch that plan until they retire. So if they have outside IRAs or previous employers, they'll need to take the RMDs from that, but they don't have to touch their current employers if they're age 70 and still working. I just want to point that out.
For those who don't want to give up their job.
Right. So still enjoy it, still love it.
Yeah, and again, this is math intensive work, by the way. Especially when we start talking the RMDs or early, what are we taking out in each place? It's a little complicated, and if you've got multiple accounts, that's why we really do encourage clients to consolidate when they go into retirement. It simplifies things for them. It simplifies things for us as planners. And that's why we encourage it. But it not only simplifies it reduces costs, right? So you don't have multiple accounts that you're paying different costs on. But it really helps when you've consolidated everything down. It makes it real simple to do all these calculations and just sort of see All right, I'm going to pull from here for a while, and then I'm going to pull from over here for a while. And this is why. This is the impact to my taxes too. Because what we're trying to do, we want to navigate in retirement to keep your tax bill as low as possible, and at the same time meet all of your income needs and your travel needs or whatever. If you're in that go-go period, which by the way, if you retire at 62, more go-go years.
Plenty of time.
Yeah, plenty of time. So during those go-go years, when you want to travel and do stuff because you got good health, it gives us that opportunity to really plan, and we have to watch those taxes because we can do that, but we can say, okay, well, if you want to do that, this is the impact to your taxes. But we want to try and navigate through that time period to keep the tax bill as low as possible for that client and still have them be able to do everything they want to do. And again, it's about what they want to do,
Right. That's why you need that plan.
That's right. The plan to help them achieve their objectives, what they want to do.
Mm-hmm.
Yeah, another point that just came to mind is when you're getting ready to retire, a lot of times your employer will offer to, hey, Wendy, I'll just send you the check and we can withhold the taxes for you. People don't understand that sometimes or think, oh, that's great, I'm getting all this money, but they're not getting a tax-free rollover to an IRA. They're just going to get a full distribution. So as you approach retirement, really make sure you understand what the options are from your employers and how the rollover process is going to work.
Yeah, I've talked about that before, and we cover that in my class a lot, is the difference between a rollover and a direct transfer. And if you go online to do this, it can be a little bit tricky because they make rollover and direct transfers sort of sound the same on the website. They don't necessarily distinguish about the impact of doing a rollover versus doing a direct transfer. The direct transfer is really, that's what you want to do. That's tax-free. You don't have to worry about it. It goes to your new IRA account. There's no taxes withheld. The rollover, on the other hand, they send you a check personally and they withhold 20% in taxes. Oh, it's a big nightmare. You just don't want to do that. It's just, and people don't, that's why a lot of times we will actually get on the phone with the client or go online with the client to make sure we get it right for them so that they don't get penalized in any way by making the wrong decision on that issue. That's
service. I like that.
The personal touch there.
Yeah, that's right. We've done it a lot. So we know what the process looks like. We know what to expect from the websites, and also on the phone, we know who to look for. And sometimes you have to dig. And now sometimes we're doing even more complex things when people retire, like a net unappreciated asset rollover, where we're taking appreciated stock from the company and moving it out into a brokerage account, which, by the way, reduces the RMD later on. But we do that, and we only have to deal with the cost basis of the money we took out. So a lot of people, so I mentioned this a lot, but if you have stock in your IRA or in your 401k, company stock, it will have a cost basis. And the reason it does is because of the net unappreciated asset rule, which allows you to take that stock out and only pay tax on the cost basis. So we've done this for many, many clients, but let's say, for instance, you're an Apple employee and you have Apple stock in your 401k, and you've been, putting that in there and over the years. Well, we all know how much Apple has appreciated in value. So, your cost basis on your Apple stock may be $100,000, but you've got almost $1 million in Apple stock in your account. So you can roll that out and put it in a brokerage account, and you only pay tax on the $100,000, which was your cost basis. The appreciated value, so now you got $1 million brokerage account. Well, guess what? If you sell some of that Apple stock in a brokerage account, you just have to pay the capital gains on that with a cost base of $100, but you have to pay the capital gains on that. And capital gains tax is lower than income tax. So again, adding flexibility to those distributions for clients would be a reason that we would look at doing that. It would also is a way for us to reduce the required minimum distribution later on in life. By taking company stock out, we reduce it's the same thing we do when we do the Roth conversions. We are reducing future required minimum distributions. which I think is real important it is real important for a lot of people, because when we do the projections and look out into the future and say, okay, based on your cash flow and your plan, guess what? When you start taking your required minimum distributions, you don't need but about half of that. The rest of it is that you're just taking out more than you need and having to pay tax on it later on. Why not take it out earlier through a Roth conversion or an NUA situation, pay tax then and put it into a tax-free situation or into a brokerage account where it's taxed at a lower rate?
That won't lower your percentage of a required minimum distribution, though. What?
It will, because
okay.
it reduces the size of the account.
Okay, just because it reduces the
Right.
size. Gotcha.
Right. It takes the count down. Doesn't change the percentage, but by reducing the account, it reduces the total amount we have to take out. And that's what's important. It's the dollar amount we're having to take out and how much tax you have to pay on it.
There is a lot to keep track of.
There is. And that's why if you're working with a planner, someone who has your best interest at heart and they're really looking to try and reduce your taxes and do all the stuff that we do, it's important. It's really helpful. It's really beneficial, and it's complicated. But for us, if because of the tools we have, and I will say that a lot of this has to do with the technology and the tools that we use, makes it relatively easy. Of course, we know how to use the tools too, which is important, because even if you had the tools, if you didn't know what you were doing, you wouldn't be that helpful. But because we have the tools and we know how to use them, we can really help people navigate this very complicated distribution process, because lots of things to consider. I'm talking too much.
No, that's all right.
I get excited about this too, if you can't
I
tell.
know you said you were going to be quiet this episode, and it's just not happened at all. All right, Mike, what do you have to add to that?
I think the point about the Roth conversion is a great opportunity for a lot of people that they don't know about. So a lot of times wait as long as you can, or at least talk to your advisor about when should I start Social Security. Do not be anxious to take it early. Let it grow. And if you do take the time to let it grow, and you have a non-retirement account you can use or cash savings, those are great years to do the Roth conversions, maybe piece by piece, moving more and more money out of your 401ks, IRAs into a Roth. It makes a lot of sense, gives you all that flexibility we discussed. But yeah, give us a call if you have any questions. This is pretty dense stuff, as David mentioned, but we would love to help.
Yeah, taking out money is fun, but taking out wisely means planning. You've got to work through the plan and understand to be wise about it. You can just pull the money out and pay tax on it, and guess what? Now you're in Tier 3 IRMA, and guess what? All of your Social Security is gonna be taxable. You're being thrown into the 37% tax bracket.
Oh no!
Yeah. So that's what can happen if you don't do it wisely. So that's what we help clients with, I'll just move it all into Roth. Well, if you do that, you're probably going to be facing all of those higher taxes. So you end up moving a lot less dollar-wise over, because you have to pay so much in taxes if you don't do it wisely. That's why we really, every year, we're looking at what's the amount of the Roth conversion that we can do wisely for the client and deliver to them the biggest bang for their buck, if you will, because we're going to move over as much assets from the taxable column to the tax-free column. That's what we're doing. We're doing a Roth conversion, taxable to tax-free, without throwing you into a higher tax bracket or creating an IRMA issue. IRMA, by the way, is the tax that you have, the additional premium you have to pay on Medicare Part B if you make too much money. And it's a pretty low threshold, by the way, for people that they can hit that pretty easily. So we don't want to do, and maybe you're already in, a lot of clients, just from their pension, their Social Security, they're in Tier 1 IRMA already. So we just want to stay out of Tier 2, because we can't prevent Tier 1, no way. But we can prevent Tier 2. So we do Roth conversions up to Tier 2, because that's usually going to keep you in the same tax bracket too. So very complicated, but with some planning, it can be done.
All right. Well, that sounds great. Thank you both. Who wants to tell me how we can get in touch with you if we have more questions?
Well, you can go to rvawealth.com. look for us there. Feel free to call David or email, and look us up on our LinkedIn page as well.
Yep, and we have on the website. You can also sign up for complimentary consultations or a 20-minute Ask Anything call. I like those. People call me sometimes, and I get some very interesting calls on the 20-minute Ask Anything.
I bet.
And hey, if you've got questions, call a planner, and it's free. We'll talk to you. But just get it on my calendar, and I'll do it.
Right. Exactly. Okay. Well, thank you to both of you, and thank you for listening today. Please like, follow, and share this podcast with your friends. Until next time.
Thank you for listening to the Unleash Your Retirement podcast. Click the follow button to be notified when new episodes become available. Visit our website at www.rvawealthmanagement.com or give us a call at 804-497-2100. And don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of RVA Wealth Management. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.
Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security or engage in any specific trading strategy. Results will vary. Past performance is no indication of future results or success. Market conditions change continuously. This commentary reflects the personal opinions, viewpoints, and analysis of RVA Wealth Management. It does not necessarily represent those of RFG Advisory, Private Client Services, their clients, or their employees. This commentary should not be regarded as a description of advisory services provided by RVA Wealth Management or RFG Advisory, or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Securities offered by registered representatives of Private Client Services member FINRA SIPC. Advisory services offered by investment advisory representatives of RFG Advisory, a registered investment advisor. Private Client Services, RVA Wealth Management, and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place.